Coming up today, stocks continue to fall on the back of more tariffs. Are we about to see more? Nvidia keeps dropping, a preview of inflation tomorrow, and I take a look at one of the most disruptive companies in the world. You don't want to miss this one, guys. Let's go. And there we have it for the third last trading day of Q1 2025. Coming in a bit mixed here today. Still a little bit of a defensive feel to it, with once again semiconductors, high growth tech continuing its pullback here as the market's still on shaky ground on the back of new tariffs coming in yesterday and a little uncertainty going into PCE inflation tomorrow, which I'll get into later on. And stick with me today because later in this video, I'll dive into a company I believe is changing the face of finance and is trading at what I think to be a very appealing valuation today. They're innovating at light speed, and I think they will inevitably overtake most traditional finance companies. But first, let's perform some technical analysis on the S&P 500 index here to determine whether this is an extended pullback in an otherwise healthy bull market, or is this potentially the start of a new bear market? And what technical signs should we be looking for to confirm what scenario we're likely to face? So first off, let's just go back a few years to see what was really the last decent extended pullback in this bull market, which I would say was Q3 going into Q4 2023, in which the market did come off about 11%, which we've pretty much done already in the S&P as well, had a 10% correction. And so what's happening now in the market? Is it more like Q3 in 2023, or is it potentially the start of a bear market like we saw in the start of 2022? Well, let's just look at the technicals to help give us some clues. And the number one most important thing in technical analysis is the trend. That's far superior than everything else. Then coming after the trend, the second most significant thing us chartists pay attention to is support and resistance. So the way we determine trend is if the market's making higher highs and higher lows, it's in an uptrend. So all markets wave up and down, and these short-term waves. So swing high, swing low, swing high. And here we are in late 2021. We just had a great year in the market. And getting towards the end of 2021, we can see here we took out that first swing low. And in the same pullback, we took out a second swing low at about 42.80 on this big hammer candle here. Then we got a bit of a bounce in what was looking potentially like a V-shaped recovery. However, we kind of stalled out. We didn't even come up and retest 4,700, and we actually took out that low on the 24th of January. So that was the first warning there, a lower low. Even though it did find support on that day, it did come up and retest this swing high, actually took it out a little bit, potentially showing some consolidation. Then, once again, we took out another swing low. So that wasn't a good signal, and the market's starting to look like it's in a downtrend. We've just made 3 consecutive lower lows, and then it kept pushing lower, couldn't even come up and retest 4,400, made yet another swing low. Had a nice bounce there in Q3 2022. Then once again, took out that prior low, but something important happened on the 13th of October. There was maximum fear and a massive gap down, which finished in a monster bullish engulfing candle, in addition to my S&P 500 oscillator here, giving us a nice bullish divergence. That was the low for the bear market 2022, 3,500. And we bounced off that. Then the market did a pullback and couldn't take out its first swing low off the bottom there. So that was the first signal that maybe the market had found its feet. We've got a higher low here. All we need now is a higher high, which the market went on to make. Once again, it pulled back, a little bit of a retest of this swing low, but it didn't take it out. So once again, that's a higher low, and we've got a higher high here. It went on to once again take it out, make a higher high, and off to the races we went. We're in a bull market. Then we got that extended pullback in Q3 2023, which we can see in the chart here with my risk on off indicator flashing red, advising some caution. We did make a couple swing lows there, but the market staged a really strong V-shaped recovery. Then we ended up taking out this high, and then brand new all-time highs. Super bullish, and once again, we're off to the races in a parabolic grind up. Bull market had a healthy pullback in Q2 24, didn't even get close to retesting that swing low. Went on to make more highs, and we had that sharp pullback in August last year. Gap down on one day, took out that swing low, but was sharply bought up. V-shaped recovery. We continued ripping into the remainder of the year, making higher highs, higher lows. That's the day after the election there. The market somewhat consolidated in Q4 last year, and then here we are today, just having taken out that swing low from mid-January and another one from early November. So technically where we stand today, it's too early to definitively say this is an extended pullback or the start of a bear market. However, my bet is it's an extended pullback. That doesn't mean we can't take out the first low we've made in this sharp pullback at 5,500. And that's why the next key level, if we do take it out, will be right around here, 5,400 to about 5,500. 54.60, where we've made prior swing lows. And since we're having a little bit of a multi-day pullback right now, again, if we can make a new swing high and take out that prior low there, if we can squeeze up above, say 58.10, that would be a bullish signal as well. Then of course the ultimate confirmation is taking out all-time highs at about 61.50. But most people are still really bearish. We're right on the cusp of going back into the extreme fear zone here, as a lot of people are convinced we're on the cusp of a recession. And we just got the latest investor sentiment survey. Once again, coming in above 50% of all respondents are bearish on the stock market for the next 6 months. These are some really elevated readings we're getting. In fact, we've just gone 5 straight weeks with the bearish sentiment above 50%. We've only seen that twice before in history. Back at the market low in October 2022, and again at another low back in October 1990, which actually went on to make 7 straight weeks, the all-time record. And this is so rare that it's only happened twice before, but both times the market was higher 1 month, 2 months, 3, 6, and 12 months later. And it does remind me of 2018, when we didn't have a slowdown in growth or corporate earnings, but rather a growth scare with the same president in office as there is now. Fears of inflation, like there is now. Fears of a global trade war, like there is now. And so back then, just like now, we also saw a multiple contraction in the market. And that's basically investors in the market discounting stocks rather than a breakdown in earnings expectations. We can really see in this chart here, highlighted in the purple, is the growth in multiples, price to earnings. In the blue, earnings per share growth, company profits. We can see in that recovery 2020, that was a huge multiple expansion. Basically, investors getting a lot more excited to own stocks, marking them up. And that was thanks to a massive explosion in liquidity, the likes we've never seen before. EPS growth eventually caught up, but the market then flipped its narrative as inflation seeped in. The Fed indicated they were going to have to start hiking rates, and we got a big multiple contraction, just like we did back in 2018, even though earnings was still holding up. And so that actually proved to be a really good buy the dip opportunity. And so once again, the market is getting discounted whilst earnings expectations are still holding up. And another positive signal we've got is a broadening of market breadth. That means more stocks are starting to outperform the index this year. And we can see the sectors that outperformed last year are underperforming this year. Discretionary stocks, tech, communication, and really trading out on its own is financials, having done well last year and this year. But what underperformed last year is performing a bit better this year, with a bit of a defensive feel to it, apart from energy and materials. We've got mining stocks actually holding up really well, in addition to gold and silver breaking out, which I'll get into later as well. But again, it all comes back to valuations. We have to put our money to work, and we always have to weigh up the options in front of us. Do we want to lend it to the government for 4% a year, or can we find better yields elsewhere? And so for sure, the S&P 500 has had a monster run this last 15 years. That automatically convinces people it has to somehow reverse all of that, or half of that, just because it's gone so far for so long. Never mind the S&P 500 index, which is market capitalization weighted, placing heavier weights on the larger companies, has been absolutely dominated by mega cap tech, which has dominated the world. Their earnings have exploded on the upside. That's skewed the market cap indices higher, and their valuations reflect that strength, currently trading at 31 times free cash flow. However, when you look at the S&P 500 equal weight index, given an equal weighting to all 500 companies, that's trading at a much more reasonable 24.7, which is actually in the mid-range over the last decade. For sure, not as cheap as 2011, which was a great time to buy stocks, not as cheap as the dip back in 2020 or the end of 2022, but it's not at extremes either. And just looking at the spread of the S&P 500 equal weighted ETF, RSP, versus the SPY, that's been significantly outperforming year to date, showing that market breadth is definitely holding up, if not potentially coming back. And that's not just in the S&P either. Looking at the NASDAQ 100 index equal weight, ETF QQQE versus the Qs, same deal. We've seen a nice bounce back after coming in really weak late last year. But at the end of the day, we've all got to make our own investing decisions, right? And so anybody out there that wants to try and time entire markets by switching out of stocks into cash, bonds, or whatever, very few people in this world can do that successfully over a long period of time, because just looking at long-term returns of stocks, bonds versus inflation, if your grandma or great-grandma back in 1900 put $1 in US stocks back then, today that would be $107,000. However, that same dollar in bonds is only $268. Even though bonds averaged more than half of the yearly return of equities, just goes to show the huge difference a few percentage points makes in compounding over a long period of time. In T-bills, basically bonds with less than a year to maturity, 3.4%, only a little bit better than inflation. But look at that difference between bonds and stocks, $268 versus $107,000. And especially in a low rate environment, bonds typically don't give good returns. In fact, the starting bond yield has the most correlation with the final returns on bonds. So bonds are great to invest in when they're above 8% or more. Changes the picture a lot. But remember, when you're in bonds, you also naturally short inflation, because if you lend your money for a year, 3-year, 5-year, you hope to get your principal back plus your coupon, your yield. Whereas a lot of equities, they have inbuilt inflation protection, because good companies with pricing power can always raise their prices. But so many people are feeling sour at the moment. Consumer sentiment is really low. No doubt the market is worried whether that's going to translate into lower consumer spending. And we'll get a taste of that in a few weeks when companies start reporting Q1 earnings and what their outlooks are. And if those come in sour, we very well print another swing low on the S&P 500 index. But no doubt it's the price action in the stock market as well that is not helping people feel great here. The wealth effect. Oxford Economics thinks every dollar change in financial wealth moves spending by 14 cents. And so, of course, a lot of households are exposed to the stock market. We all suffer from recency and herding biases. The more the market goes down, the more worse everyone feels, and that could translate into lower spending. If enough people believe it, economies can talk themselves into a recession if no one wants to spend or invest. But this wealth effect is more magnified in discretionary purchases, which also happen to be the most vulnerable to tariffs as well. No surprise to see discretionary stocks under pressure here. Exacerbated by last night's headline: new car tariffs, 25% on all vehicles and auto parts not made in the States, which will have ripple effects for sure. Very well could bump up the prices of used cars, especially those Asian and European brands as well that are going to be most affected. But one of the most insulated is Tesla. As I said at the start of the week, I think the White House put was coming for this company, and that's exactly what we got yesterday. As 100% of Teslas sold in the States are made in the States, with over 91% of all parts that go into a Tesla also made in the States. Big misconception that half of their parts or something like this are made outside the States, even though they're assembled on American soil. So it just makes the relative attractiveness of Tesla prices better to other cars that will go up in price soon. 25% tariffs is no joke. And so we can see in this chart here, Tesla up the top as one of the only original equipment manufacturer that produce all their vehicles sold in the US. Also up there, Rivian, Lucid, Isuzu. But then looking at traditional American automakers, Ford, about 78% of their vehicles are produced in the country. Big portion in Canada and Mexico in the blue, and a small portion in the rest of the world here in the yellow. General Motors, just a bit over half. And so don't be surprised to hear big plans come out of these legacy automakers, opening new plants in the States. Again, more investment, more jobs, along with other foreign companies as well that can do the same thing. Wouldn't be surprised to hear one from Toyota or potentially another Asian producer. It's really going to be the Euro company in the firing line here. And so on top of Tesla just absolutely becoming way more competitively priced relative to the competition basically overnight, Tesla is also the lowest cost car to maintain and repair. Looking at recent data from this month, average Tesla will cost about $5,000 in maintenance and repairs in its first 10 years, which is well under some other vehicles, especially those Euro ones as well, which are typically more expensive to upkeep, whilst the Asian cars can be a bit more cheaper. But once again, that's not enough to get the street excited. We just heard another bank coming out today, HSBC, cutting its Tesla price target to $130, also warning of a 50% drop, thinking Q1 deliveries will come in low, which they very well could. Europe market has been soft, but also a big part of that is consumers waiting for the new Model Y to come out. But just reading through their research note, they seem to be just focused on EVs, with no mention of Optimus Bot or Robotaxi, which Tesla's just confirmed will start in Austin this June. Once again, many analysts focused on the past, still hanging on to that narrative Tesla's only an EV company, instead of looking forward out the front windscreen. And so there's a look at the daily on Tesla today. Actually took out highs from Tuesday before reversing in the afternoon, giving us a bit of a inverted hammer, which is actually a bullish candle formation. Looking at others, didn't fare so well. GM down over 7% today. Ford down almost 4%. And actually Ferrari came out and said they're going to jack their prices up by 10% to account for nearly half of the tariff in the States. Market did a big gap down, but huge bullish engulfing on massive volume. But since they mostly sell to high net worth individuals, I'd say they're somewhat more insulated and their consumers will pay up if they want a Ferrari. Next up in the firing line, Europe, as we approach Liberation Day, the 2nd of April next week, when official reciprocal tariffs are set to kick off. Europe's still trying to work out their position on this. Did announce they'll bite back, but they seem to be dialing that back a bit, and still yet to be seen how it's going to play out with Canada and Mexico. Canada's leader going to speak with the US president over the coming days, just as he threatens far larger tariffs on the EU and Canada if they try to come out with some sort of pact to work against the States which is still possible, and that would be a clear escalation in a global trade war. I don't think it's in their interest to do, as they can't just rely on each other to grow their economies. But for sure, there's a real political desire to not bow down to the new US president. But in addition to hearing positive developments from India just 2 days ago, suggesting they're willing to cut tariffs on US goods, tens of billions of dollars. We just heard the same thing again today from Vietnam, who's going to cut tariffs on US imports, also approving Starlink in the country. So we're in a scenario now where it's advantageous for some countries to gain that first mover advantage, potentially negotiating better trade deals for them than other countries who will come on inevitably later, probably Europe, once all the dominoes start falling around the world. But no doubt investors are worried, are chips going to come in the firing line here, which is definitely possible. Maybe why the market's a little spooked on Nvidia, even though the fundamentals by far and large are holding up really well. And we just got an awesome contrarian signal today. Jim Cramer telling Nvidia investors to prepare for turbulence, saying that investors should be aware that the stock could continue to go down. Nvidia is the linchpin of this group and the pin is failing. But also today we heard from Sam Altman, the guy behind ChatGPT, on the back of a new style of images being able to be produced with the app. He said it's super fun seeing people love images in ChatGPT, but our GPUs are melting. We're going to temporarily introduce some rate limits while we work on making it more efficient. GPT free tier will get 3 generations per day. They're having to throttle use on their app because they're hitting their limits on their GPUs. What does that mean? They're going to have to re-up their compute power. From the company powering this AI boom, Nvidia, trading at $111 a share. I would still love to pick up a few shares at $103 if we get there over the coming days and weeks. As down there, we'll be looking at about 20 times forward PE, which in my mind is cheap, especially for a company like Nvidia. And if tariff fears take us down to the 90s or 80s, I won't be selling either. I'll be buying more because I don't believe tariffs are going to destroy the global economy forever. I think it's more of a short-term storm in an otherwise healthy secular trend of AI expansion, not to mention being on the cusp of going into robotics as well, which Nvidia is going to play a big role in. But also looking at some other positive developments we got today. We just got the revision come in for Q4. GDP growth in the States was actually revised up to 2.4%. But a lot of people are convinced that's about to take a 3% dive over the coming quarters into negative territory, which is required to technically be in a recession. Jobless claims came in a touch lower than expectations as well. Fewer people filing for unemployment benefits. We're seeing a bump up in entertainment spending. Looking at credit card data coming from the Bank of America, was pulling back quite a lot over the prior month, but in the last week, we've seen a sharp recovery, which is a big discretionary spending indicator. Same deal with Chinese consumers, second largest economy in the world, the growth engine of the global economy. E-commerce giants have reported stronger year-on-year revenue growth, indicating a recovery and consumption growth. Still got a ways to go. We're not back at pre-pandemic level in growth rates, but nonetheless, positive developments coming out of their huge market. Next up on deck, inflation tomorrow, PCE, personal consumption expenditure, the Fed's preferred inflation gauge. Going into it, getting quite a bit of negative sentiment as consumer expectations of inflation have shot up a lot if we're to believe the sentiment surveys, which for sure, if it did come in hot, could very well upset the market and cause a swift repricing and interest rate expectation. Even the Fed jumping on board, multiple members and presidents coming out worried that tariffs could cause permanent inflation, not temporarily, with the Fed Bank of Boston president saying it's inevitable tariffs will increase inflation in the near term. So the Fed is very much on hold, but whether they're going to increase rates again, I'm not sure if they want to do that, as that definitely wouldn't be a good thing at a time when the state's cost to service their debt is just exceeded what they spend on defense for the first time ever. And if inflation is coming back, Fed fund futures are certainly not pricing it in. Still given 2/3 chance the Fed will cut in June, maybe get another 2 cuts this year as well. But what about gold? Why is that ripping so hard of late? Is that on the back of inflation fears? Or is it just a continued rotation, flight to safety, as long-term treasuries are not really what they used to be? Or is the bull market getting carried away? Looking back in history, gold does correlate with inflation more than any other asset class. And Goldman Sachs just lifted their price target on gold to $3,300 an ounce by the end of this year, saying we could potentially get above $3,500 as well, as central banks continue to drive prices higher on their de-dollarization efforts. And we've also got record short interest on SLV, the silver ETF as well, which had a good day today, up over 2.5% on volume, pushing up to 52-week highs here, as it finally may be getting ready to once again break out to multi-year highs and go on a run. GLD as well, breaking out to brand new all-time highs today. Along with the gold miners ETF, GDX, taking out decade highs today. Just going out to a monthly chart here, we officially took out the high from August 2020 in today's trading. This is the highest this ETF has traded since 2012, 13 years ago. Could this be miners' time to shine? Certainly have had a cracker year to date so far, the best performing sector out there. Okay, onto the company that I alluded to at the start of this video that I think think is one of the most disruptive in the world and definitely in finance, Robinhood, continue to innovate and push ahead. At light speed here, just hosting an event today, the Lost City of Gold, where they introduced Robinhood Strategies, which is kind of like a robot financial advisor. It can create a strategy matched exactly to your desires, automatically invest for a really low fee, 0.25% management fee, with a yearly cap of only $250 for Robinhood Gold members. They've really invested a lot in their app, going to turn it basically into the everything finance app, getting more into traditional banking services, savings accounts, all neatly presented within their clean, easy to use app, which is largely favored by millennials. They've got more millennials than all the other traditional brokerage companies combined. Also introducing Robinhood Cortex, an AI investment tool designed to provide real-time analysis and insights that help you better navigate the markets and identify opportunities. Once again, all within the app. Also coming out and saying they can deliver cash to your door. No need to search around for an ATM machine. With the CEO, Vlad Tenev, coming out today on X and posting cash delivery as it was written with what looks to be like an old Egyptian sculpture of some sort. And so Robinhood has over 25 million accounts. They own this amazing app, got all these people highly engaged, getting into AI, more traditional banking services. They're no longer just an easy app to buy stocks like they started off. They created the whole wave of commission-free trading. They already disrupted the industry of brokerage. And like I said, they're just moving at light speed with innovation, new products and services, really cheap. They're really dialed in with the millennials. And they're not even a member of the S&P 500 yet, the index, which I think is inevitable, if not this year, next year, which will mean a torrent of capital coming their way as there's over $1 trillion around the world indexed to the S&P 500. They have to buy these companies. And the market cap's only $38 billion. And if you compare that to traditional finance wealth management companies like Charles Schwab, still a fraction of their $148 billion market cap, and absolutely minuscule against JP Morgan, $693 billion. And of course, I'm not suggesting Robinhood's going to overtake JP Morgan anytime soon. However, millennials are the future. The digital economy and the apps are already here and will more and more be the future of how people do banking. It allows for amazing economies of scale, only just starting global expansion. And I believe in the future, we'll look back and see $38 billion as being pretty cheap for Robinhood. But of course, all of this is just my opinion. Please do your own research into what you think makes for a good investment. And just wrapping it up here, we got the VIX still on an 18 handle. Volatility kind of trading around its mid-range here. Above 20, the market's really nervous, but things haven't really calmed down until we get kind of below that 17 into the 16, 15s. But considering all the tariff headlines going into Liberation Day next week, we got core PCE price index tomorrow. With option dealers not pricing in a whole lot of movement, we've actually got the VIX 1 day below the VIX 30 day at 17. So if PCE did come in hot tomorrow, that would surprise the markets. It would also be a huge divergence with Trueflation readings as well. But maybe option dealers could be pricing in some end of quarter window dressing and massive rebalancing, as tomorrow will be the second last trading day of Q1 this year, Monday being the last. So we'll see what we get tomorrow in inflation, along with the market's reactions. Bond yields have been coiling up somewhat going into it, 2-year sitting right at 4%, and we'll see how this changes come tomorrow afternoon. As always, thanks for tuning in. You're welcome to share your thoughts below this video, and I'll see you back here again this time tomorrow. Cheers.